Today, we are covering a Q1 update of 2023 tax changes. Now, we have heard from many of you over the last few years that keeping up with changing tax laws and guidelines is a top challenge for your business. So this year, we are going to be providing quarterly updates to keep you in the know. Today, I am so excited to be joined by a panel of tax experts from not only Avalara, but also Bloomberg Tax. We have a chock-full agenda of updates to share, so it's going to be a really great hour, lots of valuable information. So first off, we have Liz Armbruster. She is Avalara's Executive Vice President of Customer and Compliance Operations. She is focused on delivering scale and automation to Avalara's back-end compliance operations to ensure that all of our customers remain in good standing. Liz, always great to have you. Thanks for being here.
Thank you. Great to be here as well.
And next up, we have Michael Bologna. He is a senior correspondent at Bloomberg Tax. He covers topics that are very near and dear to Avalara's heart, things like state and local taxes and taxation on digital products. Now, he actually talks to Liz and Scott Peterson, who I'll introduce in a second, on a fairly regular basis for his column. But today is his first time joining us for a webinar, and we are so excited to have him. Michael, thanks for being here.
Nice to be here. Thank you.
And then next up, like I said, we have Scott Peterson. Scott is Avalara's Vice President of U.S. Tax Policy and Government Affairs. So he has deep understanding of all of the bills and tax legislation that's floating around out there. Scott, always great to have you. Thanks for joining us.
Well, thank you, Courtney.
Awesome. All right, let's take a quick look at the agenda and what we're going to be covering today. So we're going in kind of an inverted pyramid style today. We'll start out by covering some of the macro trends we're seeing on tax compliance globally with e-invoicing and the digitalization of tax. Then we'll hear from Scott on how today's economic landscape is affecting tax policy. Then we'll have Michael jump in and talk to us about some changes to corporate income tax and themes to be aware of on that front. And then we'll dive into the latest on economic nexus, marketplace facilitator laws, and finally go into some state-specific updates that you should be aware of before ending with a live Q&A.
And there are really two components that I want to anchor to over the next couple of slides. One is that we, as you all know, are living in a world that is changing rapidly with regard to technology, digital services, et cetera. And that plays right into the tax landscape. We're seeing that here domestically within the US, and we're seeing it manifest in a lot of different ways around the globe with regard to how you need to be compliant with regard to the multiple jurisdictions that you might be dealing with. In addition to that, we also see that digital technological landscape change how we do our work, regardless of whether it's with a tax jurisdiction or not. We see that in our daily businesses. How do we automate things? How do we become more efficient, et cetera? And it is also playing into how do we exchange between our business and government agencies. And it's actually one of the reasons why I love tax. It might be one of the reasons why you love tax too. It's ever changing. There's nothing that ever stays the same about it. So it creates complexity, it creates opportunity, et cetera. And would love to share a couple insights with you about what is happening in that world and how it might be influencing your business. So Courtney, let's move to the next slide and talk about a couple of things specific to e-invoicing. Many of you who may be doing business globally already may have some familiarity with what is e-invoicing and kind of the add-on to that, which is what is electronic reporting. There are many countries around the globe that either are already in practice with electronic invoicing and or electronic reporting, and some that are just coming up to speed. We see a lot of that already in place in locations like Brazil, but in particular seeing a very fast, rapid adoption of electronic invoicing and reporting happening in Europe. And for those of you maybe not familiar with it, at its very basics, we're talking about an electronic exchange of information, an invoice, from one entity to another. Oftentimes it happens between a business and government. It can also happen between business, and ultimately in some places, and will perpetuate throughout the world, being business to consumer. And so that is the genesis of it. Multiple countries have different templates, they have different endpoints, et cetera, which very similar to how we think about tax in terms of a thing that is taxable could be taxable in many different ways, depending on the jurisdiction you're dealing with. That's actually happening in the world of electronic invoicing also, where yes, it's digital, but the format between endpoints could be different. The endpoint itself could be different. That creates a lot of complexity for you, the business owner, because at the end of the day, you want to make sure you're compliant, but how you become compliant can be challenging with all of those differences. Across Avalara, we support a lot of different e-invoicing and e-reporting models and are doing our very best to stay ahead of that for you so that you can remain compliant regardless of where you are doing business. A couple of quick points on that as I think about the digital invoicing all the way out to reporting. There are certain countries today that are just mandating the electronic exchange of the invoice. There are some that require it before the actual transaction between supplier and buyer happens. There are some where you have to do that with the government before that happens, some of which happens afterwards. And then ultimately, when all is said and done, the most advanced countries are getting to a kind of continuous transaction control where the jurisdiction has insight into what invoices are happening when, what is the taxable amount, et cetera. And the end of period compliance becomes more of a reconciliation than an actual report. So that's happening really all over the place. For US businesses in particular, we have a bit of a different state. For those of you who responded, yes, I'm doing business internationally, you're probably already aware of some of these compliance requirements. If you're on the cusp of thinking about doing internationally, transacting internationally, these are things that you should be thinking about. But here in the United States, our market is a little bit different. And we have clearly seen across the board that the direction of travel for governments, tax authorities, et cetera, as I've just described, is one where we're going to a digital exchange. And I would say is more near time the point of transaction. But one of the challenges here in the US market is there's no central government authority to do that at the federal or state level to say, this is how we're going to go about doing e-invoicing across the United States. The US Congress, of course, could mandate a framework for it, but only for interstate transactions. Constitutionally, that's what we could do. But if that happened, it could convince states to adopt the same framework for intrastate sales, which would be helpful, less complexity, et cetera. And there's already a state level e-standard organization that does create uniformity in how states and industries transmit electronic documents. So currently no clear e-invoicing mandates either at the state or the federal level. And in addition, most businesses in the US have a more, they have a lot more commercial freedom compared to most countries in terms of the data elements, the fields required on invoice, et cetera, and how those invoices are presented to customers. However, thinking about this and getting ahead of what ultimately we believe is coming in the future, there is a coalition, the Business Payments Coalition, organized and led by the Federal Reserve Bank of Minneapolis. It's a group that's out there set up to promote adoption of electronic business-to-business payments, remittance data, invoicing, et cetera. And they've got a current initiative to develop standards and requirements to help enable that exchange of invoices. So they've been acting as a working group for a period of time. There's a pilot that has been, will be built and tested to do, a virtual network, et cetera. So a lot of information available out that I would turn your attention if this is at all interesting to you. I think as you think about future technology, et cetera, something that is readily available to read up on. And of course, if you have any inquiries, Avalara is on top of this as well. Courtney, let's move to the next slide and talk a little bit about, thank you, kind of that intersection again of, we talked about e-invoicing, what's happening globally, reporting, et cetera. But as I said, it's fueled off the back of technology, right? What's happening in the world of tech today? How is that powering not only what's happening on a digital exchange, but also thinking about, within your businesses? And I would imagine that many of you who are sitting in this tax and finance space are seeing how automation is already helping your businesses. That's no different here at Avalara. I could throw out a lot of acronyms. I'll try not to do that to you today. But when we think about artificial intelligence and machine learning, thinking about robotic process automation, everybody has access to these tools. and they are rapidly evolving how tax manifests itself in commerce today. One thing that I'd love to point out to you, just as an example, Rhode Island just introduced legislation that effectively would enact 48-hour sales tax compliance. So very different than how sales tax compliance looks in the US today. It puts credit card companies on the hook, and effectively any credit card company that collects sales, hotels, meals taxes, et cetera, for the state or any other tax for the state, or for any tax for a municipality within that state, would be providing the dollar amount of the tax to the state Department of Revenue or the local municipality, effectively within 48 hours of that transaction being processed. So it's similar to some of the countries in Europe where it's a post-transaction model, but again, different because it puts the credit card company right there in the middle. So again, leveraging technology to do that, data transfer, data exchange, visibility of data. If you think forward to that, it certainly rapidly changes the world around audit, et cetera, and effectively moves compliance to be near real time. So as a general trend, that's what I would highlight is happening across the industry. And Courtney, I'll hand this back over to you to talk about maybe a step down from the global level.
Yep, awesome. Thank you so much, Liz. So we keep hearing a lot about, just in general in the news, this economic landscape, these fears of maybe a looming economic recession. So I want to pass it over to Scott and have you talk a little bit about how does the economic landscape affect tax policy, or does it affect tax policy?
Thank you. That's a damn good question. Tax policy is created by consumers, businesses, and state politicians, and each of them not always have the same goal in mind. The economic situation we've had in the last 3 years have been nearly unprecedented. We go from a pandemic to a very short but relatively deep recession, and then all of a sudden an explosion of money from every different source. And that the influx of money from both the federal government and from, frankly, from consumers and employers, as we've continued to earn money, continue to spend money, created enormous budget surpluses, unprecedented budget surpluses. And that has put politicians in an awkward position. They're getting requests from everybody to do something about spending and/or taxes, and that is, that constant interaction with consumers and businesses creates a need to do something. And last year we saw lots of changes. Michael will get into some of that. Much of what's gone on in the last couple of years is related to income taxes, but there's been a lot of spending, a lot of education. State employees have gotten pay raises for 2 years in a row, which is nearly unheard of. Education's got additional money 2 years in a row. Last year there were politicians who were saying this is, times are different now, which, if you're an investor, the 4 worst words you ever want to hear is times are different now, because there's no such thing. Last year we saw people spending money, talking about spending money, both from an actual out the door or not coming in from tax changes that could not possibly last forever, because forever is not the way it was last year. Today, we live in a kind of a world where people are concerned about a recession. But every day that we don't have one is, I think it makes those people a little concerned whether or not they've been accurate forecasting a recession. But we are seeing states starting to do less in what they thought they would be able to do. Half a dozen states thought they would be able to eliminate their personal or corporate income taxes this year. None of them did. New Mexico started the year off thinking they were going to be able to lower their gross receipts tax, which is their sales tax, again, like they did last year. And that didn't turn out. Well, there will be another reduction this year, but that was from legislation they adopted last year. What we're seeing now are very, very small changes in tax policy, very almost in many cases, infinitesimal changes in rates. We saw South Dakota lower their sales tax rate from 4.5 down to 4.3. They initially were going to exempt the groceries from sales tax. That failed. We've seen other states make really, really small reductions in their personal and their corporate income tax, either the rates or increasing the deductions that one gets. All of the smallness that we're seeing today in tax policy changes are from this view that the good times aren't going to last, and that they're going to get to a spot where they have a normal budget, which is you have no idea how much money you're going to get. The only thing you can control is how much money you spend, and that's not where we are this year, but that's certainly where we'll be next year. We've already seen states like Massachusetts and Connecticut and in California and New York predict budget deficits for next year. Now it's really hard to do because most of those states, those 4 states in particular, are very income tax driven, and the income tax is a very hard tax to predict.
I think Scott was spot on with some of his views about where the states are financially. And it was evident in some of the corporate income tax changes that we saw walking into 2023, where we saw Arkansas, Iowa, New Hampshire, Pennsylvania, Idaho, all lowering their corporate rates. And in a couple of these cases in a fairly substantial way or meaningful way if you were operating in one of those states. This legislative session, I think Scott's right. There's still a lot of states that have some surplus that they're dealing with, but they're more cautious than they were last year. I guess I would put it that way. And the behavior of different state legislatures often depend on, if it's a red state or a blue state. Tax does have some political dynamics to it. And currently we have 28 states that are complete control by Republicans in both the House and the Senate. And to the extent that there's any tax cutting that's happening in those states, it could be a flattening of rates or a reduction in the flat rate in those states. And in several of them, they're looking at minor permanent changes to the tax code that way. There are 18 states that are completely controlled by Democrats. And in those states that if they have cash available, they're looking at more like one-off kinds of changes, one-time rebates to taxpayers, or maybe some changes to the way that they operate their earned income tax credit or their child tax credits, programs that would designed to sort of bolster the economic security of a family. I wanted to point out just a couple themes that I do see across the states, in the progressive states or the blue states in particular, that are interesting that maybe we want to watch going forward. One would be income taxes on wealth and capital gains that we have heard about in a few states. Crackdowns on tax avoidance via trusts. Gavin Newsom in California is proposing that there would be a closure of a tax loophole where wealthy families can shift some of their income into tax haven states. I think states like South Dakota or Nevada. And then also some states are looking at, taxes on profitable corporations. There was a surcharge in both New York and Connecticut, and it looks like those could be maintained in the tax year coming up. I just wanted to point out a couple changes in 5 specific states that are just interesting to me, and they're just sort of current for what's going on now. One would be Alaska, maybe a state that doesn't get a whole lot of ink, but it is one of those states that's actually running a deficit this year, and part of that has to do with its reliance on petroleum. And so with the declining oil prices, Alaska isn't getting the revenue that it is usually hoping for. And one of the solutions to that problem, which I think lawmakers hope will be long-term, is a 2% statewide sales tax. Alaska is a weird state in that it doesn't have a statewide sales tax, but it does permit localities to impose a sales tax. So that could be a big change for Alaska. California is worth mentioning too. Scott talked about the potential for deficits. It's a weird story. California had $100 billion surplus last year. Now Gavin Newsom is looking at a $22.5 billion deficit heading into 23-24. This is partially due to the hyper cyclical nature of the economy in California. And then the layoffs we're seeing in the tech industry, and income taxes just probably not going to be as robust as they have been in the past. So it's a state to watch for tax increases. Louisiana is a state maybe you want to pay attention to, just because Louisiana's tax code is just so weird, and they always seem to have some unusual problems. I think there's they started their legislative session only about a week ago, and right at the get-go, there were 100 tax bills out there. A lot of them hope to cut the income tax and the corporate income tax. Not clear if that can happen this coming year. I should mention that Louisiana is also a state that has elections this fall, and I think every elected official is standing for re-election. So some of this just might be political posturing, but there could be some substantive changes in Louisiana this next year. And then let me mention Minnesota also. Just yesterday, I think the House Tax Committee passed or approved an omnibus tax bill, which does a lot of different things. And Minnesota is an interesting state too. It's got a $17 billion surplus. It wasn't able to sort of send those surplus dollars back to taxpayers last year. So we're going to see a lot of that happening this year. And this particular bill would send about $3 billion back, it looks like. A lot of that through refundable tax credits to taxpayers, and some a new tax break on the Social Security income. But it's an interesting state also because Minnesota is cutting taxes, but it's also raising taxes. They're going to create a new top individual income tax rate on those earning over $1 million. But more interesting from the corporate income tax world is they would switch to a worldwide combined reporting, and Minnesota would be, quite alone in that. Most states that have a corporate income tax currently sort of stop the taxing at the water's edge, but this would be an effort to require corporations that have a global presence to pay a portion of those global earnings to the state of Minnesota. Definitely something to watch, and maybe something that's coming in other blue-controlled states going forward. And then finally, I'll just mention Oklahoma, just because it's doing something that's sort of interesting. They're attempting to repeal their so-called throwback rule, which is maybe a hyper-technical corporate income tax issue. Historically, states adopted rules to ensure that all earnings of a business are taxed in some jurisdiction. So you had situations where there was so-called nowhere income, from sales into another state that weren't being taxed for a couple different reasons. And Oklahoma and most states had this throwback rule that said if it's not taxed elsewhere, then we get to tax it here in Oklahoma. Oklahoma is looking to repeal that, providing some tax relief to businesses operating in Oklahoma. Arkansas did that same thing earlier this year, although that's going to be sort of a phase out over 6 years. Oregon is looking to do the same thing, and it appears that repealing of these so-called throwback rules could happen in a number of states going forward. But anyway, that's the high overview, and happy to answer any questions about that later.
Let's dive into economic nexus. So this is something that's been a very hot topic for the last 5 years. So Scott, I'm going to pass it over to you and let you talk a little bit about what that is and why it matters so much.
Thank you. Economic nexus is this thing that came about in 2018 with the United States Supreme Court case, South Dakota versus Wayfair. And in that case, the court used the South Dakota law to repeal a 1967 precedent that they were tired of, which was that states couldn't require anybody to collect their sales tax unless they had a physical presence inside their state. Lots of reasons why the court wanted to get rid of that rule. They chose South Dakota's law for some reason or another, and South Dakota's law says that if you make more than $100,000 in sales into the state or 200 separate transactions, that you have to get a license and collect their sales tax. As soon as the Supreme Court made their decision in June of 2018, every other state in the country jumped on the bandwagon. Now we have all 45 states plus District of Columbia and Puerto Rico that have a sales tax that have this economic nexus law. And that means that they can make you collect their sales tax, and frankly, probably other taxes, based solely on the number of sales you make into the state. So for South Dakota, for example, if you make more than $100,000 in gross sales, they're a gross sales state, then you have to collect their sales tax. This is there hasn't been much of a change in the way this is working out. South Dakota is repealing their 200 transaction component this year, and I expect Louisiana to do the same. Eventually, I expect every state to do the same. Otherwise, there really isn't much new that's going on, other than we're in a real serious enforcement phase. So states are out there looking for folks who are making sales into their state and asking hard questions. Are you making more than X number of sales into my state? And if so, when did you start? You remember these laws the first law went into effect on July 1, 2018, which means that when they ask you that question, how many sales do you make in my state and when did you start, they can go back to 2018. And to the effect that their statute of limitation allows them, they can make you remit back taxes back that long. So this is something you want to be very careful about. This map shows you the different thresholds. In the old days, physical presence was relatively well defined because it had been in effect for a long time. Everybody kind of knew what physical presence was. Economic nexus we thought would be very simple, and it is. It's all sales. But the states decided not to be so simple, and they have now multiple thresholds. So in South Dakota, it's $100,000 or 200 transactions. Texas, it's $500,000 in sales. In Mississippi, it's $250,000 in sales. And it's also, and I'm going to go to the next slide and show you this one. It's also a function of how they define sales. South Dakota is a gross sales state. So it's $100,000 in sales into South Dakota. It happens to be $100,000 in sales into North Dakota as well. North Dakota is a taxable sales state. So if you have to not only know where you're making sales, but you have to know what it is that you're selling and how that state taxes that, and also to whom you're making sales to know whether or not those are taxable or exempt sales. You can have exactly the same number of sales into both North Dakota and South Dakota, sell exactly the same thing to exactly the same consumers, and have two entirely different scenarios. Because South Dakota is a gross sales state, you're likely, as soon as you hit 100,000, you're going to have a license, even if you sell only exempt things or only sell things to exempt people. Whereas North Dakota is different. Once you get over $100,000, you then need to know whether or not your customers are exempt or what you sell is exempt, because that makes a big difference. So it may be simpler in South Dakota to know whether or not you have an obligation, but it's also more complicated because you're going to get there much quicker than you do in other states, and you're not going to necessarily collect any more tax. The only thing that's really new, other than South Dakota getting rid of their 200 transactions and Louisiana most likely doing that, is Missouri's brand new this year. So Missouri's economic nexus law went into effect on January 1. They are still kind of working their way through what that means for them. Remember, you probably don't know this. Missouri is a seller's use tax state. So if you're a main retailer making sales into Missouri and you exceed $100,000 in sales into Missouri, you're not going to be collecting their sales tax. You're going to be collecting their seller's use tax. You have to be registered differently than you would be if you were collecting their sales tax. And that seller's use tax concept exists in a number of other states. It's very important to know which states are sales versus seller's use and to be properly registered.
Perfect. Thanks, Scott. So I'm actually going to pass it back over to you for this next section, talk a little bit about marketplaces and some of the tax complexity there.
Thank you. So the same time that the states broadly expanded their sales tax to retailers based solely on the sales those retailers were making, they did the same thing for marketplaces. Now, they had been after marketplaces and had been a little bit successful getting marketplaces to collect before the Wayfair decision. But once the Wayfair decision went, they went all in. And they basically passed laws that said, we don't care if what you're selling is yours or not. You're a retailer. And you have all the obligations that come with being a retailer in our state. And it's based solely, not solely, based completely on the same rules that any retailer would have if they had to collect our tax. So economic nexus, physical presence nexus. Those two concepts apply regardless, and they force marketplaces to build out systems to collect sales tax along with or in conjunction with the system that they built to help retailers sell their products in those states. All 45 states have this, plus DC, Puerto Rico, and I'm going to talk about Alaska here separately. And Missouri was the latest to come on. Their law went into effect on January 1. One thing that makes Missouri different than most regarding marketplaces is that Missouri requires marketplaces to keep track of the sales of their goods separately from the sale of other people's goods. And they expect you to report them differently on the sales tax return. So their sales tax return now has a line on it for sales that are marketplace sales and sales that are your sales. So if you are someone who sells your goods plus other people's goods, you have to report those things separately in Missouri. Complication, I'm not sure I quite understand, but that's the way it is. So Alaska, they don't have a sales tax. You know, Michael talked about how Alaska's tax structure is weird. I would say it's not weird. They don't have one, I think is a better description. They don't have a tax structure. They've got oil. You know, they're the Beverly Hillbillies. They're Jed Clampett. But that oil isn't always worth as much one year as it was the next year. And so they're constantly having a yo-yo with their budget. They're broke, they're rich. They're broke, they're rich. And it's been going on forever. And they have for a long time had debates about having a real tax structure. As Michael said, there's 110 cities and boroughs, a borough's a county in Alaska, that have a sales tax. And those 110 have joined together and created a thing called a remote seller commission. And that remote seller commission built a little Department of Revenue. They built a little sales tax filing portal, and they have all adopted an identical economic nexus ordinance that looks exactly like South Dakota's law. If you make X number of sales in the state, you have to collect our sales tax. And then they give you this single portal where you can file one return for all the city and parish, county, parish, borough. We have 3 words to mean county in the United States: county, parish, and borough. So in the boroughs in Alaska, plus the cities in Alaska, they expect you to collect sales tax because they think their ordinance applies. And even though the Supreme Court decision in South Dakota versus Wayfair never said a word about cities and certainly didn't say a word about boroughs, they believe they have as much authority as a state, given that they're acting as a group and they've created this single portal where you can file your sales tax.
Michael, I'm going to pass it over to you and have you dive into Maryland's digital advertising tax and what's going on there.
Yeah, a pretty fascinating story, really. Maryland took the step, I think, 2 years ago to enact a digital advertising tax, and it remains the only state in the country that has such a thing, and something that they learned, from European Union nations. But if Maryland is successful with what they are doing, it really could open the floodgates, I think, for several other states to do the same. So Maryland is the only state that imposes a gross receipts tax on digital advertising. It's a tax of between 2.5% and 10% of the gross revenue from digital ads, targeted at Maryland residents, but that is earned by companies with annual revenue above $100 million. So that's kind of a small group, but it's among the largest corporations in the world. Think Google and Facebook and Amazon and Microsoft that make that kind of targeted advertising towards consumers. This tax structure was attacked within weeks of its enactment. First by the U.S. Chamber of Commerce and a bunch of tech trade associations. That is a case that was in federal court, or is in federal court. A district court dismissed the action by these plaintiffs under the Tax Injunction Act. And if you don't know what that is, the TIA generally bars federal courts from adjudicating an issue where there is a state court able to, remedy the situation. That is a case that is currently before the U.S. Court of Appeals for the Fourth Circuit. We'll see what happens with that. But the tax was also challenged in state court by Comcast and Verizon and on somewhat similar grounds. And in that particular case, the two companies were able to get a ruling by a judge from the bench where she agreed that the tax program violates the U.S. Constitution and also a federal law known as the Federal Internet Tax Freedom Act, which generally bars states and localities from creating special taxes that tax tech companies or internet-based companies differently than than similar companies existing in the economy. So anyway, that case is actually now has escalated to the Maryland Supreme Court, and we're going to have oral arguments actually on May the 5th in that matter, and that could really it's not exactly sure what the court could do, but they may well rule on constitutional grounds. But if, again, as I said, if Maryland is successful at getting this done, I suspect we will see more states doing this. It could create a lot of revenue for the states, but I think it also speaks of some level of frustration that state lawmakers, particularly Democratic lawmakers, have with tech companies that are earning a lot of revenue and paying, in their view, very little taxes. So anyway, something definitely we want to watch.
Absolutely. Yeah, this one is an interesting case with lots of little nuances. We'll see what happens. Scott, let's have you talk a little bit about some of the other state-specific updates and kind of highlights that have been noteworthy.
Thank you. So as you can see in our slide, that we had one all teed up there that we thought was going to get more conversation than it did. But there was legislation introduced in Arizona that would have made significant is too small a word to describe the changes that they were going to make to that. They were going to create one rate for the state, which there are states that have one rate. That not an unusual thing. But it would have also then created a concept where state sales taxes would be kind of home state based. You're an Arizona retailer, you're selling into South Dakota. The Arizona Department of Revenue would collect the tax that you collected from consumers in South Dakota, and then you and Arizona and South Dakota would work out how to get that money back. In this, there would be this constant 45 state plus District of Columbia, DC, and Puerto Rico. No, excuse me, I said DC twice. Exchange of sales tax collection. It required the creation of something that doesn't exist today. And it would, honestly, I'm not sure it would have made things much more complicated than the world is today, even though the Arizona tax is very complicated. We didn't talk about this earlier, but there's a concept that was adopted last year in Colorado called a retail delivery fee. And it is a fee imposed upon retailers who ship goods inside of Colorado. And it's a 27-cent fee, one 27-cent fee per invoice that's applied every time there's something shipped in the state that's subject to state sales tax. Not a very simple concept. No, let me say it differently. A very simple concept that is not very simple to administer. What's new this year is that Minnesota and New York are both considering the same thing. Now, we're just about at the end of both of those legislative sessions, so we'll see if they actually get it done. But this is not a thing to just dismiss. These things are complicated, even though it's just a few cents. South Dakota was going to exempt groceries, but instead they decided to lower their sales tax rate. Very controversial. Louisiana is thinking about multiple changes. They have a very complicated sales tax, and because there's about 70 local governments in Arizona or in Louisiana that administer their own sales tax. So you have the state and you have the locals, and there's a lot of complexity that comes with that concept. They're in court right now, in federal court. There's a company called Halstead Beads out of Arizona that's suing them, arguing that's an unconstitutional burden on interstate commerce. They're arguing that it's so much of a burden that they aren't even going to collect the tax in Louisiana because it will cost them multiple times to do the administration instead of actually collecting the tax. So collect $1,000 in tax, cost them $4,000 to do it. Something that's new this year, well, it's mostly new. It comes up once in a while, but this year it seems new because there's so much of it. There's 22 bills introduced around the country that would exempt the interchange fee that your payment processors charge you whenever you accept a credit card from the sales tax. Today, those are subject to sales tax. And not because they're specifically subject to sales tax, but because they're built into the price of the product. And when the retailer charges you $110 for your good and you use your credit card, well, the retailer doesn't get $110 back. They get like $107 back, but they owe sales tax so it's $100 product and $10 in sales tax. They charge you $110. They only get $107 back, but they still owe $10 in sales tax. I could certainly understand why the retailers in the country don't like this. Depending on how this is written into law, it could be extraordinarily complicated to actually administer. It's a great concept to have a conversation about, not such an easy thing to actually put into place.
But we've had a lot of great questions that have come in. Let me dive into one that we talked about most recently, regarding that Colorado retail delivery fee. So this person is asking, do retail delivery fees apply to remote sellers shipping from out of state into the said state like Colorado?
Yes. Yep.
Easy
it
enough.
is. But I'll put it in their words. It applies to any retailer who has a legal requirement to collect that state sales tax. So if you have physical presence in Colorado, obviously you have to collect sales tax, the fee applies. If you have economic nexus, which means you make more than $100,000 in sales into Colorado, you have an obligation to collect the sales tax, then the fee applies. If you're below the $100,000 and you don't legally required to collect their sales tax, then you wouldn't have to collect the retail fee.
Okay, got it. And then there was also another question about going back to economic nexus, but for out-of-country sellers, so businesses that are in another country, but they're selling into the United States, do they have to abide by the economic nexus laws in those states?
Yes, but let me say it differently. There is nothing in the United States Constitution or in state law that exempts foreign sellers from obligations to collect state and local taxes. There are no tax treaties. Well, I'll say this differently. None of the tax treaties that the United States has in place cover state and local taxes. So there is nothing that exists out there that precludes the state from forcing you to collect their tax. Now, there may be some practical implications around their ability to actually get that done, but there's nothing that precludes them from trying.
Okay. And also on economic nexus, someone just asked, how are transactions defined in the 200 transaction threshold?
Invoice.
Okay.
Individual invoices. You could have 1,000 things in an invoice or one thing in an invoice. Each invoice is a transaction.
Got it. Okay.
Can I throw one question at Scott? You said something about 22 states had bills on exempting those interchange fees. Did anyone enact it?
Not yet.
Okay.
Yeah.
Journalist getting his answers in
sorry.
the live webinar. No, I love it. I love it. Let me scroll through some more of these questions here. Oh, this was a good one that came in early. So is there a logical connection between the reduction of corporate income tax rates and the increased sales tax revenues as a result of economic nexus? And I can reread that if you want me to, but any thoughts on that? So reduction of corporate income tax rates and increased sales tax revenues from economic nexus.
Well, I'll take a shot at this, then Michael can take a shot at it. There is a very concerted lobbyist organization that economic theorists behind that believe that corporate income taxes shouldn't exist in the first place. That you're not really taxing the corporation. You're either taxing the customers who buy the thing from the corporation, or you're taxing the owners of the corporation, or you're taxing the employees of the corporation. But that the corporation as itself doesn't actually pay the tax. The tax it's rolled down to either customers in higher prices, employees in lower wages, or owners in lower income. So any kind of thing. That exists out whether there's money in state coffers or not.
Okay.
Well, that's a good point, Scott. I was going to say that some of these proposals you see, particularly in the South, where politicians have talked about getting rid of the corporate income tax, some of it is premised on getting some more revenue out of the sales tax. So I don't know if that really has much to do with the Wayfair and that sort of thing. There's this talk that maybe we should use the sales tax more aggressively and do away with what corporations pay in income tax.
Okay. Let's see. Someone was asking about, so if they're making sales on Amazon, so they're selling through a marketplace, they're wanting to know how would a third-party seller like themselves be able to find out which states they're selling into via Amazon or via that marketplace? Does the marketplace provide some type of overall report, or how do they keep track of that information?
I can't speak. I doubt if any of us can speak to every marketplace, but I know for Amazon, they're in the marketplace sellers portal, their little admin site. There are reports that they can create that show where they have made sales. Now, nobody can tell you where your sales are going to be, but Amazon does have reports in there where you can tell you where you did make sales.
And also where they're holding inventory.
Thank you. Very good.
Yep. All right. Let's see if there are a couple other questions.
I want to ask Liz a question.
I do too.
I get to go first. Liz, the rest of the world is different from us. The nation states have greater capacity to enforce laws than the states inside the United States. Do you think we're going to get to a spot where every country does e-invoicing?
I do, eventually. I absolutely do. I think it's a while to get there, but we're already seeing an example in the EU and in adjacent countries where early legislation has been introduced. They go about it their own way, et cetera. The businesses who are impacted by selling into either government agencies and or B2B in those regions are already raising their hand saying, this is crazy. Why do we have to do it in Hungary one way, Italy another, France a different way? And so the legislative body coming together as a group and saying, hey, we need to make this much more simple, in the same way that streamline sales tax, same thing, right? Hey, if we really want to ensure that businesses everywhere are being compliant, we recognize the burden that sits upon our shoulders to reduce that complexity such that we can streamline, get some commonality, frameworks are similar, et cetera. So your question's slightly different. Will everybody get there? Yes. And then eventually, I think the pressure to be compliant and across such a vast number of businesses that are doing international commerce, et cetera, will push us to a place where not only does technology take us there, but we'll also do it in a more streamlined way.
So Liz, you brought up a great point. For everybody that's on the call, Liz leads the team that does all of our tax compliance, and there are 47 different ways to file sales tax in the United States. There's probably 100 different ways to file lodging taxes. And when you become a multinational company, and you're taking those 150 different ways of doing basically the same thing and taking that multiplies times 170 different countries on the planet.
And the burden, right, on the business just becomes enormous, right? Can't do it. So
can't do it.
Not only tax technology providers like ourselves find ways to help businesses streamline that, but also coalitions and groups of businesses come together and put pressure onto the regulatory agencies to say, like, time out, we got to streamline this, do it differently, because otherwise you're not going to get data and dollars the way that you expect data and dollars to be timely and accurate. That's the risk we face, which is already happening.
Absolutely. Awesome. Well, I learned a lot. I hope that everyone who joined us for the past hour got some valuable information out of this. So thank you so much to our speakers, Liz, Michael, Scott. Love all the things that we talked about and the interaction at the end here. This was great. So appreciate you sharing your time and expertise with us. Hopefully we'll have you back in the future for another one of our webinars. But again, thank you so much, everyone, for joining us, and we will see you for one of our future webinars very soon.